Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the Private Lenders Podcast. We appreciate it. Real quick before we get started here, we are having a live event here in Maryland next week, June 4th and 5th. To learn more, we probably have one spot left open still. Check out hardmoneymastermind.com and click on live events. Okay. All right. This is a big topic. This is a big, important topic and really encapsulates like everything that we focus on, the entire way with which we approach this business. So backing up a little bit, out of college, I started doing mortgage loans, commercial and residential lending for a big commercial bank. And Jason got in the mortgage business shortly after that as well. And you know, I think it was a good business 101. It was a good place to start. I enjoyed my 5 years there. I learned a good amount. It was a good 101 about a number of topics like credit, real estate, title, finance stuff, marketing. It was a really good first job in the business world. And we did learn real estate. We did learn, you know, how to run a transaction, how to underwrite property, how to underwrite borrower. It was good. And that rolled right into the private lending stuff that we'll get to soon. But some of the issues that we had with that business and the reason why I wasn't going to be in it forever are a couple things. One, I didn't like the economics of it. I didn't think there was enough bottom line profit. It's just a high volume business. You're cranking out loans. You're doing all this stuff. There's a lot of movement, a lot of moving parts. And as a loan originator or even as an office, because I had, you know, good knowledge on the details of the office and its profitability and P&L and all that stuff, it wasn't that impressive. It wasn't a profitable enough business, in my opinion. In addition to that, the other thing that I didn't like about that business is that there's a serious lack of control in terms of processing and closing your deals. There's a bunch of people involved, underwriters, processors, secondary market with pricing, changing underwriting guidelines, changing pricing. You oftentimes felt like you did not have control of your own deals. And that annoyed me. I think you'd probably agree with that one.
Yeah, 100%. I mean, you're just doing deals. That's all it is. It's just deal after deal after deal. Yeah. And guess what? You know, the end of the month comes and your pipeline is clean. And now you got to fill it back up. And you got to do more deals and more deals and more deals. And there's not really a trail.
Yeah, no residual
money that comes in. You know, you're not. Yeah, you can have a book of business, I guess, but not really an income book of business like a potential financial advisor could get or a private lender could get with servicing money and income coming in month after month with monthly payments. Like it was that. I mean, so sometimes it's just kind of tiring, just selling and selling and selling. Like you're just a salesperson over and over and over and over and over. You're not really building a business. Even if you're the owner of that mortgage company, you're still, you know, never really felt like building a business. But you're right. The lack of control, interest rates change, underwriting requirements change, credit score requirements change. Like things would just change. And like you would get, I can't tell you how many times I would follow the metrics to a T and I would get close to the closing table. And like this also differs between A paper, subprime, and things like that. But like you get to the closing table and things were different than you quoted or told the borrower. And that's heartbreaking because that looks badly on you. Yeah. Like nobody cares about the big bank or the big mortgage company. Like it looks badly about you. You're telling somebody that you could do something and you can't perform because of that.
Yeah. So let's keep going. After a 5-year run in the mortgage business, we were transitioning into HMB. We had started it on the side. We're about to go full time into it. This is mid 2007 before we ever closed a deal. And Jason went first full time into HMB. A few months after that, I followed. And that was shortly after we closed our first deal. And we were pretty amazed by the model. Like we had a little bit of capital, not enough at the time, but enough to do a few deals. Also, mind you, the market at the time was 15 and 5 points, 15% for private money back then. And a couple years later, it started coming down. But the profit margins were just huge. You could do $1 million worth of loans in a month and your origination fees alone are $50,000, you know? Plus, we had complete control.
All profit too.
All profit. We were running a super lean shop. Like we had $500 a month in rent that we were paying to a title company. We did everything ourselves at the time, so we didn't have hardly any overhead, no payroll, a little bit of marketing expense, and also we had complete control. Us and the capital investor. At the beginning, we were, probably more involved with underwriting alongside our capital investors than we are now. Now we just handle everything, and we have such a track record with them. It just rolls like that. But still, we had complete control over what was going on here, over our due diligence that we wanted to do or not do, the borrower documents that we thought were important versus a bunch of stuff we didn't need, right? Getting title ordered, getting insurance in, we controlled it all, and we're sending the money. We are entering and approving our own wires, and that's just complete opposite from the mortgage business in terms of how much control you have over a transaction. And then, okay, fast forward even more, and so all right, we love this business from day one. It was hard. It was, starting any company is hard, but as far as the business model itself, we were, absolutely obsessed with it, and it started growing, and the portfolio started growing, and servicing fees started to get real substantial, and all of that stuff. And then I might be skipping forward a little bit too much in the story here, but I wanted to kind of contrast this so we can make our full point. Fast forward to like 2014, something like that. We had been in the business 7 years or so. The real estate market had been going up slowly and steadily ever since the crash. Interest rates were low, and the institutional money decided they wanted to be in the hard money space. And I remember even here in the office I'm in right now, having some New York guys here, some New York suits, trying to pitch us on using their capital instead of our private investors. And of course, we looked at it like, why not, consider it? So we looked at it, and it was like, okay, it'll cost this much. Here are your fees. Here are the junk fees that come with every transaction. Here's the process for getting approval from us, right? And here's your underwriting matrix. And I was like, oh no, looks just like the mortgage business. This looks just like the mortgage business. They're giving us an underwriting matrix to use to qualify our deals. Here's your pricing. Here's your add-ons, your LTV add-ons, your credit score add-on. I'm like, add-ons? No, I had awful flashbacks to the mortgage industry. Now we have to get approval from these turkeys to fund our own loans. This sounds terrible. We're out.
No doubt. All right, so you kind of did miss an important part of the story as well, related to the investment vehicle side of it. So, which I thought you were going to bring up, but you didn't. But I'll bring it up because I like.
No, we're getting to it.
Okay,
but yeah,
because I like telling that story. Well, because that was pre 2014 when that moment. Right. That was like 2012. So, well, maybe even 2010, 2011, 2012, somewhere like that. Because I think that's a really important, good part about this, because you're right. We're like, why would we have ever worked at a mortgage company? Like, this is crappy. Like, we make all the rules. We determine what deals work, what deals don't work. Like, we have full control over all this. So there's the control, and obviously there was the profitability. Like in the mortgage business, like you had to do a lot of deals to make, a few bips or whatever. Like you had to perform and do a ton of stuff. And not only on that on the front end, but you also, there wasn't much that came in on the back end. It gets to a point, and if you're a private hard money lending company listening to this, you're understand exactly what I'm about to say. If you have a large portfolio, either a fund or even direct placement where you have servicing income coming in, that amount of money becomes substantial. Early on, you have a few deals outstanding, a few $1,000,000. It's like, great, I make a few $100 here, a few $100 here, maybe a few $1,000 here. Like it's good. But like that turns into a big number, that arbitrage between the money you're lending out on and the money that your capital investors are getting. So let's talk about real quick the investment vehicle story, because this was an aha moment for us. I don't think when we started, we realized how big of an investment vehicle this is. And I think these companies that have gone the institutional route are missing the boat on all of this, because that's where this is like you're building yourself an investment vehicle for you, your family, your friends, and people you want to take on as capital investors. So like, let's call it 2012. I think it was before that, but like, Chris and I each had some money deployed into deals. Like, every once in a while we'd put some of our money in, we'd save some money. We'd put some money back into some deals. And I remember at the end of the year, and we were doing 1098s, 1099s, all that other stuff. So we went and I pulled a 1099 INT from one of our bigger investors who had maybe been to our office once, who certainly didn't really know what was going on with any of his deals. And he invested in some decent deals. He had millions of dollars deployed, a few $1 million deployed into deals. And I'm looking at and I pull his 1099 INT, right? Pretend if you're watching this on YouTube, I pull it up because it was all snail mail back then, right? Stuff wasn't all digital,
Right.
like snail mail. So I pulled it out and I said, Chris, guess what so-and-so's 1099 INT was? And in essence, it was $400,000. And we're like, God dang it. This dude, threw a few $1 million of his own money to work. He didn't originate any of the deals. He didn't find any of the deals. He wasn't involved in anything except putting the capital into these deals and trusted us to do the heavy lifting and service everything for him. And this guy made more freaking money than we made.
He took home more from HMB deals than we did.
We worked our asses off for 365 days straight. And this was early on, right? Like year 3, call it, or whatever. He making more money than we are. Like, that's the aha moment of like, we need to take every additional dollar that we have and we need to put it into this investment vehicle so we can get that 10% return. And most of the deals that we do, we just pay each of us, full freight on it, but 13%. And then we dug into that. We dug into the rule of 72, divide the interest rate that you're getting based on 70 to determine how long it takes to double your money. So it's like, okay, well, if we can achieve a 14.5% interest rate every 5 years, we double our money. It's that simple. And the passive investment side of this has nothing to do with the active hard work that we're doing, right? So if we don't have to have capital investors involved in this deal, in essence, we're making twice as much money on these deals. So if every deal that we put our money into, we will make twice as much money in. So that was a big thing for us. The investment vehicle side of this that we really, really saw the light of day of was like year 3, year 4 of the business. And that's what really motivated us to be like, you know what? This is a great business, but like, this is even a better investment vehicle. It got to a point where, we saw this quote. And of course, I don't remember the quote, the Warren Buffett quote. And last time we talked about this, somebody, a very nice, loyal listener for the Private Lenders podcast, sent me the quote. I think either
somebody
emailed
you
it to
after the show.
And I need to go back because I got to give him credit for that. And I need to go and I got to put that back on my wall. And in essence, it was like, hey, if you find a business that spits out high rates of return with your own personal capital, continue to put your own personal capital into that business and continue to grow it as big as you can, because that's where the magic happens. And it's hard to find an actual business that's also an investment vehicle. And hard money lending is one of them.
Yeah. I mean, it became the whole goal. Like after that, and since then, and in recent years, and moving forward, right? Lending our own funds is a very large part of why we're doing this. And contrast that with the institutional stuff. Like there are a lot of companies out there that are only in business because institutional capital came into the space. Otherwise, they were never going to raise capital. They were never going to, underwrite and deploy according to what they thought was a good loan, a good deal. They wouldn't be in the business. And so we were thinking about this, brought up this topic and how we want to frame this. And I think it really, like I said before, it just really defines our whole approach to this business compared to a lot of the industry. And so in our mastermind group and everything else, everyone's bought in on this. Everyone's bought in. A lot of people come our way because they have made a good amount of money in another niche, maybe in real estate, maybe elsewhere, and now they want to deploy it in private loans, earning a double-digit rate of return, and that's when they get into the space, and that's absolutely great, right? I mean, it's a good amount of bang for the buck. It's a good amount of profit compared to the work that goes into it. And so everyone in the mastermind's bought in. Everyone's on the same page. But there's a large percentage of the industry that just wants to be a mortgage company. They just want to be a mortgage company, only they happen to do investment property loans. And it's also ironic that, I don't mind the shift in branding of this industry from hard money to private money. I think that's totally fine. I mean, granted, our company's called Hard Money Bankers, so whatever. But I've always thought it's really ironic that shift to private money has largely come from the institutional guys, which is very specifically not private money. That is bank-like Wall Street finance type money, not the private investors and your own funds, which is what should be the definition of private money. But I just thought that's kind of a funny thing about our industry. But the point remains, like, there are basically two different ways, and there's probably a blend sort of thing where you could do both of these things. I know that some companies do run debt funds and also sometimes sell loans to institutional. There could be ways to do that. I don't know how it would affect underwriting and everything else, but for the most part, it's kind of divided down the middle in terms of you either approach it like a mortgage company or you approach it like an investment vehicle. And I think that is a very, very interesting fact about our industry.
Yeah, no, it's a great topic. Okay, so I found the Warren Buffett quote. I'm going to read it off. First, I'm going to thank Steve Thomas from Red Lodge Capital in Florida, in Sarasota, because he listened to one of our episodes and he emailed this to us, and now I have it. So he emailed me and said, "Good morning. Enjoyed your recent podcast. Number one reason to be a private lender. Here's the quote you were looking for. Thumbs up. Thank you." So here it is. And actually, one of the reasons I'm going to read this quote off again is hopefully whoever's cutting this episode of our reels and our shorts definitely cut this exact quote, because this is a good quote, and it needs to be out there on all social media.
So the ideal business to the editors during the podcast. That's perfect.
We'll see if they're actually listening to our whole
part
episode.
Right here.
We'll see if they're listening to our whole episode when they're doing it.
Yeah.
The ideal business is one that generates a lot of cash, which can be reinvested at high rates of return, especially at double-digit rates. If you find such a business, you should go all in. Warren Buffett's quote. And he's right. And we, I don't remember exactly when or how I found that quote. I don't know if it was from, I think it might have been from the Snowball book when we were reading that. Anyways, I agree. And that's the point. This isn't only a business for us. If you ask people, people in our mastermind group ask us all the time, are these types of companies saleable? Would people be interested in buying these things? And I don't know. I don't think so, or at least not at the premium that you would be willing to sell it for. But this is an investment vehicle. So the business cash flow is getting pushed into the investment vehicle, which is spitting out very high rates of return, and it can be. So they work together and it turns into a beautiful thing. So point being is, you want to run a mortgage company, go run a mortgage company. If you want to run an investment vehicle, then hard money lending and private money lending is the perfect fit for you. That's just where it's at. And you do what you want to do. Do you. You don't have to necessarily run a hard money lending operation. But to us, it makes the most sense. And Chris telling our backstory, there was a point that we were going to start our own mortgage company, because
conventional mortgage.
And thank God we didn't. Thank God we found that. We started Hard Money Bankers in 2007, and that first deal, which people have heard our first deal story, which was an interesting one. It worked out great. But it was just a unique one because it wasn't in a state that we lend in. It was just a real unique situation. But that $10,000 that came in from that first deal, went into the bank account. There was our seed capital. Never had to do a capital contribution ever since then. That $10,000 funded everything, and it started everything up. So it's the beauty of this business.
Yeah. So one last thing on that note. The investment vehicle part of it. I do get a good amount of emails from people who are listening or watching about investing with HMB, and we are full. We're heavy on capital. We have been for a while, so we can't take on any additional capital, but I can definitely point you in the right direction. There are some really good lenders in our mastermind that could have the ability to take on some additional capital. So if you're looking to do that, just reach out to me, Chris at hardmoneybankers.com. Shoot me an email, I'll point you in the right direction, and we will see everybody here next time on the Private Lenders Podcast.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice.
please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.